Imagine for a second, you're sitting in a doctor's office. You're looking at an x-ray of your arm on one of those glowing light boards.
Oh, yeah. Never a fun place to be.
Right. And there's a very clear, jagged white line right across the bone. The doctor points to it with a pen and says, there it is. That's the break.
It's totally definitive.
Exactly. It's precise. There is absolutely no arguing with the physics of it. But now I want you to shift that image.
Okay.
Imagine you are sitting alone at your computer desk. It's like 10:00 p.m., the glow of the monitor is reflecting off your face, and you are staring at a naked financial trading chart.
A vastly different kind of glowing screen.
Vastly different, because whether it's Bitcoin, gold, the S&P 500, it really doesn't matter. What you're looking at is just this chaotic, violent sea of green and red candlesticks.
It's overwhelming.
It looks less like a medical diagnosis and more like a heart monitor strapped to someone who is actively running from a bear.
That is painfully accurate. There's no clear, jagged white line telling you what to do.
Right. There is just raw, unfiltered panic, greed, and noise, and you've got money on the line, you're sweating, and you're asking yourself, what on earth is actually happening here?
It's that exact feeling of sensory overload that ruins so many traders.
It really is. And today's mission on this deep dive is to cut right through that noise. We're going to look at a diagnostic tool for financial markets that takes that murky, terrifying chaos and turns it into a map.
Which is something every trader desperately needs.
Exactly. We are pulling from a really fascinating stack of sources today from expert trading educators. We've got the technical breakdowns of FX Street's Ian Coleman, the crypto market insights from MoneyZG, and the foundational risk and strategy tutorials from the Learn to Trade group.
We are pattern-seeking creatures, right? Yeah. We desperately want things to be visible, to be categorized.
Well, like the X-ray.
Yes. We want a clear, flashing neon sign that says buy or sell, but naked charts absolutely refuse to give you that.
They just don't.
They just give you the raw data of human emotion. Every single candlestick is just a record of an argument between buyers and sellers.
And when you look at thousands of those arguments at once, your brain just short circuits.
It totally does.
And the instinct, at least for me, is to start slapping a million different indicators on the screen.
Oh, the classic retail trader trap.
Right. You throw on an RSI, a MACD, 3 different moving averages, Bollinger Bands.
And suddenly your chart looks like a Jackson Pollock painting.
Yes. And you're suffering from massive analysis paralysis. One line tells you to buy, another tells you to sell, and you just end up completely frozen.
But then you step into the world of Japanese technical analysis.
And suddenly you are handed a single, elegant set of tools that completely rewires how you view that chaos.
It really does.
We are decoding the Ichimoku Cloud today. It's this powerful, comprehensive, trend-following indicator developed in Japan decades ago.
And roughly translated, it means a one-glance equilibrium chart.
One glance. I love that. It is designed to show you the trend, the momentum, and the dynamic support and resistance all at exactly the same time. You literally just need one glance.
And that one glance concept is the absolute definition of what makes it so revolutionary in the trading space.
Because it simplifies things.
Right. It takes the muddy waters of a naked chart and applies a very specific, deeply intentional mathematical structure.
It forces you to see the market's true underlying skeletal structure.
Instead of just reacting to the loudest, most volatile candlestick on the right edge of your screen, it's a philosophy of trading just as much as it is a mathematical tool.
And if you are listening to this right now, staring at your own charts, here's why this matters directly to you.
Absolutely.
If you have ever struggled with jumping into markets too early because of FOMO, fear of missing out, or if you find yourself constantly chopped to pieces in a sideways market, this deep dive is going to show you how to build a robust, incredibly patient trading approach.
Which is the holy grail of trading.
Okay. Let's unpack this. Before we can start finding these high-probability macro trade setups, we need to completely understand the tools on our dashboard.
We have to know what we're looking at.
Right. We are moving from the high-level promise of the Ichimoku Cloud down to its foundational mathematical building blocks. So, looking at our sources, particularly the detailed line-by-line breakdown from FX Street, they highlight several key components.
And we have to tackle the Japanese terms here.
Yeah, and I'll be honest, when you first load this up, it feels incredibly intimidating.
It looks like a foreign language.
Literally.
Yeah.
We have the Tenkan Sen, the Kijun Sen, the Kumo, which is the actual cloud drawn by the Senku spans, and finally the Chikou Span, which is also known as the lagging line.
That's a lot of vocabulary.
I feel like I need an encyclopedia and a translator just to open my charting software.
It could definitely sound like a barrier to entry for a lot of Western traders.
Oh, for sure.
But I promise you, once you map these terms to physical metaphors, to what they are actually doing on the chart, the sheer elegance of the system reveals itself. It stops being math and starts being a story.
Okay, I like stories. Let's take this apart piece by piece. Let's start with those first two lines you mentioned, the Tenkan Sen and the Kijun Sen.
Good place to start. Now, if you are a retail trader and you look at a chart with just these two lines plotted, your brain is immediately going to fire off a familiar pattern recognition.
Yeah, you're going to say, oh, I know what those are. Those are just moving averages.
Exactly.
Because if I'm looking at it, they look exactly like a fast-moving average and a slow-moving average crossing over each other. It looks like a standard 9 EMA and 21 EMA crossover strategy. They hug the price action.
But what's fascinating here is that they are fundamentally mathematically different from traditional moving averages.
Okay, how so?
Well, this difference is the secret sauce of the whole system. A standard moving average, like a 50-day simple moving average, takes the closing prices of those 50 days, adds them all up into one big number, and divides by 50.
Right, it smooths out the data based entirely on where the market closed each day.
But the Ichimoku system, which was designed by Goichi Hosoda back in the 1930s, doesn't care only about the close.
Wait, really? It ignores the close.
It doesn't ignore it, but Hosoda realized that the extremes of the day, the absolute peak of the buying frenzy, and the absolute bottom of the selling panic matter just as much.
Oh, that makes sense.
So the Tenkan Sen, which is often translated as the conversion line, takes the absolute highest high and the absolute lowest low of the last 9 periods, adds them together, and divides by 2.
Oh, wow. Okay, pause right there. I want to make sure I'm visualizing this correctly.
Go for it.
So it is not an average of closing prices smeared together over 9 days. It is taking the ceiling of the room over the last 9 days and the floor of the room over the last 9 days and drawing a line exactly halfway between them.
Precisely. It finds the exact midpoint of the trading range. It is the literal center of gravity for the last 9 periods.
That is a huge distinction.
It is. And the Kijun Sen, which is called the baseline, does the exact same mathematical formula.
So it finds the midpoint between the highest high and the lowest low.
Right, but it does it over a much longer time frame, the last 26 periods.
Okay, so a 9-period fast line and a 26-period slow line.
Now, to understand why Hosoda chose 9 and 26, you have to look at the historical context.
Oh, I love the history behind this stuff.
In Japan, in the 1930s, the trading week was 6 days long. So 9 periods roughly represented 1.5 weeks of trading data. 26 periods represented one entire complete month of trading.
Okay, that context is incredibly helpful. Because in modern crypto trading, where markets are open 24/7, people are always arguing about whether to change those settings.
Yeah, that's a whole separate debate.
But let's stick to the visual for a second. Because they measure the midpoint of a defined high-low range, I've noticed something strange on these charts.
The flat lines.
Yes. These lines, the Tenkan and especially the Kijun, will often print totally flat. They just draw a horizontal line straight across the screen for days at a time.
They do.
I have to push back on this a bit. If the Kijun Sen goes flat for weeks, doesn't that just make it a useless dead indicator? Why is a flat line helpful?
It's actually the opposite of useless.
But a moving average will curve and snake around during consolidation trying to follow the price. Why do I want an indicator that just gives up and goes flat?
That is the exact trap of Western technical analysis.
Oh.
We're taught that an indicator should always be moving, always be hugging the price.
Right. If it's not moving, it's broken.
But think about what a market in consolidation actually is. It's a tug of war where neither side is winning.
Okay.
The highest high hasn't been broken. The lowest low hasn't been broken. The room hasn't changed size.
I'm tracking.
If you use a moving average, it snakes through that consolidation and gives you a dozen false signals, making you think a trend has started when it hasn't.
Oh man, I've been faked out by that so many times.
We all have. But the Kijun Sen draws a hard, flat shelf. It visually screams at you, the market is in perfect equilibrium right here. Nothing has structurally changed.
Oh wow, so a flat line isn't a dead indicator.
Not at all. It's a massive warning sign of a range-bound market. And when price finally breaks away from that flat shelf, you know a true structural imbalance has occurred.
That is a phenomenal way to look at it. So instead of a wavy line lagging behind the price and tricking you into bad trades, you get these defined steps.
Exactly. You get a staircase of equilibrium.
But that brings us to the centerpiece of the whole system, the absolute namesake of the indicator, the Kumo, or the cloud.
The main event.
When I look at the tutorials, especially the visual charting guides from MoneyZG, the cloud looks like this massive shaded entity that floats around the price action. Sometimes it's green, sometimes it's red.
It's very distinct.
I like to think of it like a meteorological weather map. Just like a meteorologist looks at the thickness of storm clouds on a radar to predict the severity of a hurricane, the sources talk about looking at the cloud thickness to gauge the strength of support or resistance.
That is a brilliant analogy, and it aligns perfectly with how the indicator was intended to be used.
Really? A weather map.
Yeah. The cloud is the defining feature of Ichimoku. It is created by two boundary lines, Chikou Span A and Chikou Span B.
Okay, hit me with the math again so it isn't just magic.
Chikou Span A is simply the midpoint between our first two lines, the Tenkan and the Kijun. It is an average of the fast momentum and the slow momentum.
Got it. Fast and slow, midpoint.
Chikou Span B is the true macro anchor. It calculates the midpoint of the highest high and lowest low over the last 52 periods.
So back in the 1930s, 52 periods would be?
Exactly 2 months of data.
Ah, okay. So Span A reacts to the medium term and Span B anchors to the macro 2-month reality.
Correct. The space shaded in between those two lines is the Kumo. But here's the magic trick of the Ichimoku system, and what makes it completely unlike almost any other indicator on the planet.
Okay, what's the trick? Because so far, I'm following you, but it just sounds like more midpoints. We have a fast midpoint, a slow midpoint, and a macro midpoint. Why is shading the area between them so revolutionary?
Because it doesn't plot those lines where the current price is.
Wait, what?
It mathematically shifts them 26 periods into the future.
You're losing me.
It literally takes the data it calculates today and plots it 26 candles to the right into the blank, empty space of your chart where no price action has happened yet.
Wait. It draws the indicator ahead of the current price.
Yes.
It projects a shaded cloud into the total blank space on the right side of the screen.
It does. Unlike standard Western indicators like the RSI or the MACD that only tell you what just happened, looking backward in the rearview mirror, the Ichimoku components project forward.
That is wild.
They take the current momentum, the current macro equilibrium, and they cast a physical shadow into the future.
So that shaded area hanging out in the empty space is the future Kumo.
Exactly. And going back to your weather analogy, the FX Street source specifically notes that the changing colors of this future cloud and the thickness of the cloud in that forward projected space act as an early warning system for the trader.
Okay, my brain is starting to hurt in a good way.
It's a lot to take in.
So if I'm sitting at my desk looking at a daily chart of Bitcoin today, I can look 26 days to the right, a full month into the future, and see a massive, thick red cloud looming in the empty space.
Yep.
And that tells me what? That a financial storm is coming. How can an indicator possibly know what the market will do a month from now?
Well, it doesn't predict the future like a crystal ball. It maps historical market memory into the future.
Historical market memory. Okay, unpack that for me.
Think of it this way. A thick cloud represents a massive zone of historical consolidation. Let's explain the actual mechanics of bag holders.
Oh, bag holders, the unsung heroes of market liquidity.
Right. Imagine the price of an asset spent 2 months chopping around between $40,000 and $50,000. Millions of shares or coins traded hands. People bought at the top, people bought at the bottom.
Just massive volume in that zone.
Exactly. Then the price crashes to 30,000.
Yeah.
Everyone who bought in that 40K to 50K zone is now trapped. They are holding the bag. They are sweating, bleeding money, and praying to just get their money back.
Right. The classic retail trader prayer, just let me get back to break even and I swear I'll sell.
Exactly. So the Ichimoku system calculates that massive zone of historical volume and equilibrium, and it projects it forward as a thick cloud.
Okay, I see where you're going with this.
When the price eventually recovers and tries to push up into that thick cloud, what happens? It hits all those trapped bag holders.
And they all smash the sell button.
As soon as the price reaches their break-even point, they sell. That massive human relief creates a brick wall of selling pressure. That is why the cloud acts as resistance.
So a thick cloud means?
A thick cloud means there is a massive amount of historical market memory, A lot of trapped traders that will require a monumental amount of new buying volume to push through.
And a thin cloud.
A thin cloud, on the other hand, means the price moved through that historical area very quickly. There aren't many trapped traders there. It's a weak spot in the enemy line.
So prices can slice right through a thin cloud like a hot knife through butter.
Precisely. It visualizes the psychological friction of the market.
That is wild. You aren't just looking at lines crossing. You are looking at a visual representation of human psychology and trapped liquidity projected into the path of the current price.
It's amazing, isn't it?
It's like seeing the landmines on a battlefield before you step there.
That's exactly what it is.
All right, there's one more line to demystify before we have our full dashboard assembled. The Chikou Span, or the lagging line.
Yep.
Now, if the cloud projects 26 periods into the future, what does the Chikou Span do?
The Chikou Span is the polar opposite. It takes the current closing price, literally what the asset is trading for right this exact second, and plots it as a single line 26 periods in the past.
It shifts today's price backwards.
Yes.
Okay, I'm going to be the proxy for the listener here. You are telling me to look at today's price overlaid on last month's chart.
Correct.
That sounds like a software glitch, not a trading strategy. Why on earth would I want to see today's price drawn a month ago? How does that help me trade today?
This is where the true aha moment of the Ichimoku system usually happens for traders. It answers one of the most vital, foundational questions in trading.
Which is
today's momentum actually stronger than it was a month ago?
Ooh.
By plotting today's closing price directly over the actual price candles from 26 periods ago, you can see at a single glance exactly how today's buyers stack up against last month's buyers.
Oh, I see it.
Right. If the Chikou Span, which is just today's price, is floating high up in open empty space above the old price candles from a month ago, it means everyone who bought a month ago is in massive profit.
They are happy.
They're very happy. They're not looking to panic sell. Therefore, there is no historical overhead resistance. You have true, unhindered, blue sky, bullish momentum.
But if the Chikou Span is tangled up inside the bodies of the old candlesticks,
or struggling below them, it means today's price is fighting a losing battle against the people who bought a month ago. You have a choppy, range-bound market full of trapped traders looking to sell at break-even.
the Chikou Span is the ghost of traders past, giving you their blessing or their curse.
That is an incredibly powerful visual, the ghost of traders past.
Okay, I am really starting to see the one-glance genius here. You look right, you see the future psychological resistance. You look left, you see if the ghosts of the past are going to dump their bags on you. You look center, you see the immediate momentum of the 9 and 26-day midpoints.
It's a holistic ecosystem.
It really is. So now that we know what the Tenkan, Kijun, Kumo, and Chikou are physically doing, how do they interact to tell us who is actually in control of the market?
Now we get to the strategy.
Right. We need to move from the mathematical definitions to the actual market philosophy. Looking at the tutorials across all our sources, the core rule of the Ichimoku Cloud provides this overarching view to identify bullish, bearish, or neutral biases on higher time frames.
Yes.
And the Kumo acts as that dynamic support and resistance. But there is a massive, crucial rule plastered in bold font across all these educational materials.
Yeah, I know what you're going to say.
Avoid trades based on price action within the cloud.
Yes. That is perhaps the single most fundamental law of the Ichimoku system. Do not trade the chop. Do not trade inside the Kumo.
But I don't buy that. I really have to push back on this on behalf of every aggressive retail trader out there.
Okay, let's hear it.
If the whole goal is to catch massive overarching trends, why do the sources explicitly tell us to avoid trading when the price enters the cloud? Isn't that where the action is starting?
It feels that way, sure.
Yeah. Let's say the price has been in a horrible bear market, way below the cloud. Finally, it starts rallying. It pushes up and enters the bottom of the cloud. Isn't that the very beginning of the breakout?
It's the beginning of a test.
But if I wait for the price to completely clear the top of the cloud before I buy, I've missed 20% of the rally. You were telling me to intentionally leave money on the table. Why wouldn't I want to buy in early and catch the whole move?
It is so incredibly tempting, isn't it? It is human nature, driven by ego, to want to be the very first person to the party.
We all want to catch the absolute bottom.
We want to be the visionary who saw the reversal before anyone else. But if we connect this to the bigger picture, you have to remember what the cloud physically represents mechanically.
The bag holders.
We just talked about the bag holders. The cloud is the zone between the 26-period equilibrium and the 52-period equilibrium. It is the ultimate zone of historical compromise and trapped liquidity.
So it's a war zone.
When price enters the cloud, it is walking into a minefield. It is entering a battleground where neither the buyers nor the sellers have a clear, definitive advantage. The inside of the cloud is a neutral, violent, turbulent zone.
So it's literally like flying a commercial airplane into a thunderhead. You don't know what the updrafts and downdrafts are going to do to you.
Exactly. Trading inside the cloud is gambling, plain and simple. You might pop out the top into clear blue skies and look like a genius.
Yeah.
Or what happens 80% of the time is you get battered around by the turbulence, the price hits a pocket of trapped sellers, and you get violently pushed right back out the bottom of the cloud, stopping you out for a loss.
Felt that pain.
The FX Street source notes that the cloud is about identifying market structure. By forcing you to wait for the price to completely clear the cloud, the system is forcing you to wait for the market to declare a definitive, undisputed winner.
Even if it means missing the first part of the move.
Yes, you miss the first 10 or 20% of the move. The Ichimoku system accepts that. It wants you to miss the chaotic beginning of a trend to guarantee that you safely capture the incredibly lucrative, smooth, middle 60% of the trend.
It sacrifices early entry for high probability.
Exactly.
That makes a lot of sense, especially when you think about the psychological pain of getting chopped up in a sideways market. I've been there.
It's exhausting.
You buy the bottom, it goes up, you feel like a god, then it instantly violently reverses and you're stopped out. You do that 5 times in a row and your account is bled dry by 1,000 paper cuts.
It's the worst feeling in trading.
So the cloud is basically a visual filter for market noise. If you are inside the noise, you sit on your hands and protect your capital.
That's the golden rule.
So understanding the philosophy of the weather is great, but how do we actually pull the trigger? Let's walk through the step-by-step setup for a breakout strategy as outlined in these educational materials.
Let's do it.
Let's frame this as a story. I'm a retail trader. I've got my coffee. I've got my daily chart of an asset. I've got my crazy forward projecting and backward lagging lines all set up. What is step 1 of a textbook long entry?
Step 1 of the ultimate breakout strategy starts with the fastest moving parts of the system, the Tenkan Sen and the Kijun Sen.
Okay, the 9 and the 26 midpoints.
You are sitting with your coffee, scanning charts, and you are looking for a crossover. If you're looking for a bullish trade, a long position, you want the fast line, the 9-period Tenkan Sen, to cross up and over the slower 26-period Kijun Sen.
This is your initial short-term signal of shifting momentum.
It mathematically tells you that the center of gravity for the last 9 days is now suddenly higher than the center of gravity for the last month. The bulls are waking up.
Okay, I see the cross. The 9 crosses the 26. In a traditional moving average strategy, my heart rate spikes, my finger goes to the mouse, and I am buying the market right there.
You jump in the gun.
But based on what we just talked about, I'm guessing Ichimoku telling me to take my hand off the mouse.
Far from it. Do not click buy. That crossover is just the alarm clock waking you up.
Just an alarm clock.
It just tells you to start paying attention to this specific chart. Step 2 is zooming out and checking the macro environment. The cloud, the Kumo.
Where exactly on the screen did this Tenkan and Kijun crossover happen?
Right. If the crossover happened way down below the cloud, it's a weak counter-trend signal. You might just be seeing a temporary dead cat bounce in a vicious bear market.
And if it happens inside the cloud?
If the crossover happened inside the cloud, as we just discussed, it's neutral, turbulent, and highly dangerous. Do not touch it.
Okay, so what do we want to see?
We want to see the price moving clearly above the dynamic resistance of the Kumo. So step 2 is the cloud breakout. You want to see a full daily candlestick close definitively above the top boundary of the cloud.
Not just a wick that pokes out.
Not just a wick that pokes out and gets slapped down, but a strong body close above the thunderhead.
Here's where it gets really interesting to me, because reading the tutorials from Learn to Trade Group and FX Street, they make it explicitly clear that this is an alignment strategy.
Yes, alignment is the key word.
It is not a single trigger system. It's a multi-layer confirmation system where every single component, past, present, and future, must agree before you risk a single dollar.
Exactly.
So we have our short-term momentum crossover. We have our present price closing above the macro future cloud. I feel pretty good about this trade. What is step 3?
Step 3 is the ultimate confirmation, and frankly, it's the step that most impatient retail traders skip to their own detriment, which usually leads to bone accounts.
Oh, wow. Okay, no pressure.
The sources heavily emphasize using the Chikou Span, the lagging line, to confirm the macro structure before entering.
The ghost of traders past.
Yes. Remember, You have your cross, your price is above the cloud, but now you have to look 26 periods to the left on your chart and ask, where is the Chikou Span right now relative to the ghosts of the past?
And what exactly do we need to see the ghost doing to give us the green light?
If you are going long, you need the Chikou Span to be completely, utterly clear of the price action from 26 periods ago. It must be plotting in open, empty space above the old candlesticks.
Open air.
And, crucially, it must also be above the cloud from 26 periods ago. It needs open air. Let's paint a nightmare scenario.
Oh, I love a good nightmare scenario.
Today's price is breaking out above the cloud. The Tenkan crossed the Kijun. You feel great. But you look back 26 days, and the lagging line is currently ramming right into the middle of a massive, thick cluster of old candlesticks from a previous failed rally.
Oh, so it's hitting historical resistance.
The Ichimoku system is grabbing you by the shoulders and screaming, "Caution! There is massive hidden historical resistance right here. The people who bought a month ago are about to dump their bags on you."
Meaning this breakout is highly likely to be a fake out.
Exactly.
Wow, that is brilliant. So by requiring the Chikou Span to confirm the cloud breakout, the system structurally forces the trader to wait for the highest probability setups.
It saves you from yourself.
It's like requiring 3 different, highly complex keys to open a bank vault. The short-term momentum has to agree, the medium-term price action has to clear the weather, and the historical momentum has to have open skies.
And if even one key doesn't turn, the vault stays locked and you don't trade.
That multi-layered confirmation is exactly what helps professional traders avoid fake-outs. We've all had those painful trades where the price breaks out of a range, it looks so incredibly bullish, you hit the buy button, and literally the very next hour, a massive red candle prints.
Reverses the whole move and stops you out for a brutal loss.
Yes, it's agonizing.
The Ichimoku system, by demanding alignment across time, demanding that the past, the present, and the projected future all agree on the bullish thesis, drastically reduces those false signals.
It instills a philosophy that you should always prefer to be late and right, rather than early and wrong.
I love that. Late and right rather than early and wrong.
But theories and perfectly drawn lines are meaningless without real charts. In the real market, things get messy. Let's look at the specific asset examples provided in our sources to see this play out in real time. And more importantly, I want to explore the psychological toll of waiting for these setups.
Because honestly, listening to you describe this, it sounds agonizingly slow.
It does. The sources provide 3 distinct market scenarios that I want to unpack in detail. We have a clear signal on the WTI, that's crude oil daily chart.
Okay.
We have an aggressive correction in the gold price, and of course Bitcoin does this all the time too, as Money's EG covers. And we have waiting for the signal on the Euro daily chart. Let's start with oil. What does a clear signal actually feel like to trade?
On a clear textbook signal like the WTI daily chart presented in the FX Street breakdown, trading actually feels incredibly boring.
Boring.
Which is how good trading should feel. Let's walk through the timeline. You have a long period of consolidation in oil. Geopolitics are quiet. The price is trapped under a massive, thick red cloud. You are doing nothing. You are watching Netflix.
Okay, I can do that.
Then the fundamental shift. Momentum wakes up. You see the 9-period Tenkan cross up over the 26-period Kijun. Your alarm clock rings.
You pause Netflix.
A few days later, a strong green daily candle rallies and breaks out strongly above the top boundary of the cloud. You check your future cloud 26 days to the right, and it has twisted from a bearish red to a bullish green, projecting future support.
Keys 1 and 2 are turning.
Finally, you look 26 days to the left. Your Chikou Span has broken completely above the old price action. It is in clear blue skies. Every single key has turned. It's textbook. You enter the trade.
And from there?
From there, the beauty of the system is that you don't have to overthink it. You just ride the trend. As long as the price stays above the Kijun Sen or stays above the cloud, you let the market do the heavy lifting.
Okay, that sounds like a dream scenario, but the markets aren't always textbook. They are usually vicious.
Especially crypto and metals.
Right. The educational material explicitly brings up gold, and we see this exact same price action constantly in crypto too. Assets known for wild face-melting swings. The sources describe an aggressive correction.
Yeah, these are terrifying if you aren't prepared.
I want to dive deep into the psychology of this. What happens when the market decides to violently test your conviction? Let's say we are looking at Bitcoin or gold, and the market drops 5% in an hour.
This is exactly where the Ichimoku Cloud earns its keep and saves retail traders from themselves. Let's paint the picture.
Go for it.
You are in a beautiful bullish trend on gold. The setup was perfect. The price has been trending well above the cloud for weeks. You are up thousands of dollars in unrealized profit. You feel like a genius.
The best feeling in the world.
Then suddenly, at 8:30 a.m., a bad inflation report drops. The algorithms take over. A massive, terrifying red candlestick prints on your screen. Gold plummets.
An aggressive, violent correction.
Your unrealized profits are vanishing by the second. Your heart rate is at 120 beats per minute.
I'm sweating just thinking about it.
A traditional retail trader, using a tight moving average or just trading naked price action, is going to panic. They're going to get spooked, assume the macro trend is dead, and market sell their entire position, maybe even at a loss, just to stop the pain.
I have felt that exact pain. The urge to just click close position so you can go back to sleep is overwhelming. But what does the Ichimoku trader do? They look at the cloud.
Exactly. The Ichimoku trader takes a breath and looks at the macro structure. Well, even with that massive, terrifying red candle, where is the price right now relative to the Kumo?
Right, because the Kumo project support.
In an aggressive correction, the price might slice violently down through the fast Tenkan Sen. It might even test the slower Kijun Sen. But as you look at your chart, you see that the price is crashing right into the top of a massive, thick green Kumo that is acting as dynamic support beneath it.
The cloud is catching the fall.
The Ichimoku system coldly tells you, yes, this volatility is scary. Yes, you gave back some profit. But structurally, the macro bulls are still entirely in control. The historical equilibrium has not been broken. Hold the line.
That is incredibly powerful for dealing with the emotional swings of trading. It's like having a stoic mentor standing over your shoulder, slapping your hand away from the sell button.
It acts as an emotional anchor. It separates the noise from the signal.
It prevents you from being shaken out of a structurally sound macro trade by short-term, news-driven volatility.
Exactly.
But then we have the third scenario, and this is the one that fascinates me the most from a pure psychological standpoint. The Eurod daily chart in the examples is simply labeled, waiting for the signal.
The hardest part of trading.
I look at that wording, and I think of a wildlife photographer. A guy who travels to the Arctic, builds a blind in the snow, sits there for 14 days straight, freezing, drinking thermos coffee, just waiting to get one single perfect photograph of a snow leopard.
That is an amazing comparison.
If the leopard doesn't show up, he doesn't take a picture of a squirrel and call it a day. He just waits. Is the absolute hardest part of trading the Ichimoku Cloud just sitting on your hands and doing nothing?
I wholeheartedly agree with that comparison. It is the perfect metaphor. The sources specifically, explicitly state that this strategy is designed to combat overtrading and help you stay in strong moves longer.
It demands immense, almost monk-like discipline.
In that Eurod scenario, let's look at what might be happening. Maybe the price has rallied and broken above the cloud. It looks bullish.
Okay, so key 2 turned.
But you look left, and the lagging line is still trapped inside the bodies of old candlesticks. Or maybe the lagging line is clear, but the price is still meandering inside the turbulent thunderhead of the Kumo.
So the system is screaming at you, the vault is not open, do not act.
And as a trader, especially a retail trader sitting at home looking at a glowing screen, doing nothing feels like you're actively failing.
It really does. You have money in your account, the market is open, the candles are moving, you feel this intense pressure that you should be clicking buttons to make money. If you aren't trading, you aren't working.
Precisely. The psychology of boredom and patience is the ultimate filter that separates profitable traders from gamblers. You have to let the aggressive corrections play out.
You have to sit in the blind and wait for the snow leopard.
You have to wait for the cloud, the moving lines, and the Chikou Span to fully, perfectly align before risking your hard-earned capital. The Ichimoku system forces you to accept a very hard truth. The market does not owe you a trade today.
Oof, that's a tough pill to swallow.
It does not owe you a setup every week. If the macro setup isn't there, your job as a trader is to fiercely protect your capital by doing absolutely nothing.
So this strategy is explicitly suited for medium-term swing trading on daily or 4-hour charts.
It is not designed for intraday scalping on a 1-minute or 5-minute chart where you take 20 trades a day. It is about capturing the massive, undeniable meat of a macro move. And macro moves take time to build.
Speaking of risking that hard-earned capital, we need to have a serious reality check here. No indicator, no matter how elegant or mathematically sound, is a crystal ball.
Absolutely not.
Even with perfect textbook 4-layer alignment across time and space, trades fail. geopolitical black swan events happen, an institutional algorithm decides to dump a massive billion-dollar position, and the market turns on a dime.
That's the reality of the game.
We need to look at the severe risk warnings embedded in these trading tutorials, particularly from the Learn to Trade group. They include very stark, sobering warnings about margin trading, the insanely high risk of loss due to leverage, and the harsh reality that these financial products are complex and dangerous.
It is a vital, non-negotiable reality check. You can have the most beautiful Ichimoku setup in the world. You can have a pristine cloud breakout, perfect Tenkan momentum, flawless lagging line confirmation in open air.
And the trade can still immediately reverse and collapse.
It is a game of probabilities, not certainties. And if you are trading with leverage, meaning you are borrowing money from your exchange or broker to artificially amplify your position size, a very small, normal market move against you can result in massive, catastrophic losses.
The source material is very blunt about this. Traders can lose their entire initial investment, or sometimes even more if they get caught in a liquidation cascade, if they don't utilize strict robotic risk management.
It happens every single day in crypto.
So what does this all mean for you, the listener, who is trying to apply this? It means avoiding impulsive emotional trades, absolutely. But it also means knowing exactly to the penny where you are getting out before you even get in.
Yes.
And the beauty of the Ichimoku system, in my opinion, is that it builds stop-loss placement right into its visual geographic structure.
This raises an important question for every single person who hits a buy button. How much are you willing to lose on a single setup? Professional institutional traders rarely risk more than 1 or 2% of their total account equity on any one trade.
The Ichimoku Cloud is fundamentally a tool for managing that risk.
When you finally enter a trade on a perfect cloud breakout, where does your emergency exit go? Where's your stop loss?
Naturally, it goes just below the bottom edge of the Kumo, or you can dynamically trail it just below the Kijun Sen as it moves up.
The indicator literally draws the line in the sand for you. It visually tells you if the price falls below this massive historical support zone, the macro structural trend has objectively failed, and you must exit the trade immediately. No hoping, no praying.
But, and this is the dark side of retail trading, the indicator on your screen cannot physically reach out and stop you from doing something stupid.
No, we can't.
It can't stop you from manually dragging your stop loss lower because you don't want to take a loss. It can't stop you from doubling down and adding margin to a losing position, or over leveraging a small account 50x because you feel certain about a trade.
And that's where people blow up their accounts.
The tutorials emphasize that the cloud keeps you out of bad trades, like avoiding the turbulent chop inside the cloud. But it cannot save a trader who ignores basic mathematical position sizing or succumbs to the emotional urge to treat the market like a casino.
Exactly. The Learn to Trade group aggressively warns that financial products traded on margin are absolutely not suited to all investors. You have to internalize that the Ichimoku Cloud is a framework for identifying high probability.
It puts the statistical odds in your favor by demanding alignment across multiple timeframes of momentum.
But risk management is the armor that ensures you survive long enough for those probabilities to actually play out over 100 trades. Yeah. If you blow 50% of your account on one bad, over-leveraged trade because you were impatient, it doesn't matter how well you can read the Chikou Span. You're out of the game.
Okay, let's take a deep breath and recap the massive journey we've just been on. We took that terrifying, chaotic, naked chart that causes so much anxiety, and we overlaid the Ichimoku equilibrium system.
We covered a lot of ground.
We decoded the intimidating Japanese terminology, learning how the Tenkan and Kijun Sen measure the midpoints of extremes to show true equilibrium, not just closing averages.
A huge distinction.
We learned how the Kumo cloud takes macro data and physically projects it 26 periods into the future to show us dynamic psychological support and resistance zones based on trapped traders.
Nice bag holder.
And we learned how the Chikou lagging line looks 26 periods into the past, consulting the ghosts of previous buyers for ultimate confirmation.
We also walked through the narrative, step-by-step confirmation process of building a breakout thesis, emphasizing the vital, agonizing importance of patience.
We learned from real-world examples like WTI oil that true trends take time to develop.
And we learned that you have to use the cloud as an emotional anchor to weather aggressive corrections like we see in gold or Bitcoin.
We learned to respect the discipline of waiting for the perfect signal, much like the wildlife photographer on that year-odd chart. And most importantly, we grounded every piece of this strategy in the strict necessity of risk management and the existential dangers of leverage.
It really is an incredible holistic system when you understand the human psychology and logic beneath the math.
It is. But it leaves me with one final provocative thought building on the sources we've reviewed today. We live in an era of increasingly algorithmic, ultra-fast, AI-driven trading. The Learn to Trade notes even hinted at AI trader resources being heavily marketed to retail traders now.
Oh yeah, the bots are everywhere.
Wall Street firms are using high-frequency bots that are scraping data, reading order books, and executing thousands of trades in literal microseconds.
They're operating on a completely different microscopic battlefield.
Right. But if the entire philosophy of the Ichimoku Cloud is fundamentally about macro human discipline, literally forcing a human trader to slow down, to sit on their hands, and to wait for a multi-layered historical, present, and future confirmation before acting does, relying purely on visual, macro, medium-term indicators like the cloud, give the patient retail swing trader an edge that high-frequency bots might completely miss in their frantic microsecond scalping.
That's a fascinating angle.
Does extreme, unshakable patience become the ultimate alpha in a market that is utterly dominated by speed and noise?
That is a phenomenal philosophical question to end on. While the algorithms are fighting a bloody war over pennies and the chaotic noise of a one-minute chart, the disciplined swing trader using Ichimoku is calmly sitting above the fray, waiting to capture the massive dollars in the undeniable macro trend.
It suggests that the greatest weapon a retail trader has against Wall Street isn't faster software or fiber optic cables.
It's the psychological fortitude to do absolutely nothing until the stars, or in this case, the clouds, perfectly align.
And we want to hear from you on exactly that point. Do you currently use the Ichimoku Cloud in your own chart analysis? And if so, how has it improved your trading patience, your emotional control, and ultimately your profitability? Have you successfully used the cloud to wait out a choppy, dangerous market? Or did you let FOMO take over and fly straight into the thunderhead? Let us know.
We'd love to hear those stories.
Thank you for joining us on this massive deep dive into the muddy waters of technical analysis and trading psychology. Keep learning, keep fiercely protecting your capital, keep questioning your assumptions, and as always, stay curious. Until next time.